Hi everyone, let's go over my bullish and bearish Elliott wave scenarios on Bitcoin, starting with the bullish scenario on the 4-hour time frame, where we're looking for a 5-wave impulsive structure to the upside. The common target for your wave 5 is between 76.9k and 73.4k, and the invalidation is 65.5k, as in an impulse, a wave 1 and a wave 4 are not allowed to overlap. Price has to take out the high of wave 3 at 72k before moving down to the invalidation level. If price takes out this high, the invalidation will be removed. Inside wave 4, the highest probability scenario at the moment would be a sideways triangle, a 5-wave structure, wave A, B, C, D, E, and then we look for an impulsive structure to the upside. It's definitely not a very nice triangle, as wave C inside wave B only managed to move towards the 0.618 trend-based fib extension taken from the low to the high of A to the low of wave B, which is a rare target for a wave C in a zigzag of 535, and also this wave A has a great potential of being a 3-wave ABC, and ending wave B at this low is not amazing, as we then somehow need to count a WXY in this structure. Inside wave A, we can count a simple zigzag. Inside wave C, a WXY, and only one of the waves in a triangle is allowed to be a complex structure, which in this case is wave C, as this is a WXY, and all of the other waves have to be simple structures in a wave ABC. That means that in wave D, we then have a simple ABC, as well as in wave E, to finish the triangle and look for price to move towards the upside. That means that we are then looking for an impulse, a 5-wave structure, wave 1 finished, 2 finished, 3 potentially finished, looking for 4, and then one more move towards the upside in a wave 5. The invalidation for this scenario is price moving to the downside and hitting the 0.618 at 69.6k, taken from the low to the high of wave 3. If we look for resistance towards the upside, of course we have the high over here that we have to keep in mind, 72k, but we also have a blue box here, 73.1k to 73.6k. Could be a nice area to top out and start retracing, and then based on the retracement we can reassess the probabilities in this sideways range between pretty much 74k and 66k. The bearish scenario is an impulse to the upside, where we're still looking for a retracement in a wave 2, after which we look for continuation to the upside in a wave 3. Probabilities are a bit lower for this scenario, as inside this wave 1 we then need to count a finished impulse to the upside, a 1, 2, 3, 4, 5. Wave 4, however, is incredibly short in time compared to your wave 2, which does lower the probabilities a bit, but also this wave 4 did not even touch a usual minimum target for a wave 4, which is the 0.236 Fibonacci taken from the low of 2 to the high of your wave 3. Now, the common target for your wave 2 is between the 0.5 and the 786 Fibonacci, taken from the low to the high of wave 1, giving you a target between 64.3k and 59.8k. The 382 is uncommon at 66k, and the 886 is rare at 58.2k. Inside wave 2, we are then looking for a 3-wave corrective structure to the downside in a zigzag, a 5-wave A, a 3-wave B, and then a 5-wave C to the downside. The common target area for your wave C is between the 1 and the 1.618 trend-based fib extension, taken from the high to the low of A to the high of wave B, giving you a target between 66k and 62.5k. What does lower the probabilities for this scenario is that wave A has to be a 5-wave structure, which means a wave 1, 2, 3, sideways 4, and a long wave 5. In this impulse to the downside, wave 5 in this case is your extended wave, which is rare, as by far most commonly a wave 3 is the longest, strongest and most extended wave instead of a wave 5. Inside this wave B, we then look for a 3-wave corrective structure to the upside. In this scenario, we are then looking for a WXY, zigzag in W, flat in X, and a flat structure in a wave Y. Has to be said that this wave Y is very long in time now compared to your wave W, as the high here is made after the 5 fib time, taken from the start to the end of W to the end of wave X. It's not an invalidation, it just impacts the probability slightly. We are ranging inside the common target area for a wave Y, and we don't want to see price taking out this high. Preferably your wave C of the flat in wave Y, 3 wave A, 3 wave B, 5 wave C, is finished, because if price would move to the upside right now, it will make a new high after the 2-fib time, which is taken from the start of A to the end of wave B. A wave C should not really be twice the length of A plus B. That really lowers the probabilities for this scenario as well. If this high is the end of your wave C, therefore the end of your wave Y, and on a higher time frame the end of your wave B to move towards the downside in a bigger wave C, we want to count bearish impulsive structures to the downside over here. On the lower time frame, we can only think about 3 structures: an impulse, a diagonal, or a double 1-2. In an impulse, we are looking for a wave 1, 2, 3, 4, and a wave 5, preferably no overlap between a wave 1 and a wave 4. If we count an impulse down here, we have a wave 1, 2, 3, 4, and 5, but you can see that there is overlap between a wave 1 and a wave 4, which is not what we like to see. Secondly, we then have a potential diagonal, a 1, 2, 3, 4, a 5-wave structure. But as you can see here, the diagonal will be an expanding diagonal, and an expanding diagonal is rare, never preferred, unless all of the other scenarios fail. That then leaves us with a double 1-2, where preferably we were already moving towards the downside, because in a double 1-2 we then would have a wave 1, 2, 1, 2, possibly another 1, 2, and then a move towards the downside immediately. But that is not what we got, as price then eventually retraced back towards the upside, creating a much bigger range. Therefore, the probabilities in this local structure are lower at the moment for bigger bearish impulsive structures to the downside, and the probabilities would be higher for this to be a bigger corrective structure, which in turn increases probabilities that after ranging, we expect price to move towards the upside to take the highs. Looking at these CVD divergences, we have big bearish CVD divergences in this range, both bullish and bearish. On the CVD chart, you can see a lower high on price, but a much higher high on yellow, a bearish CVD divergence, and also on blue with the lower high here, lower high on price, higher high on the CVD. At the same time though, price moved to the downside and we have bullish CVDs at the lows of the range, higher low on price, lower low on the CVD in blue. As this can be quite confusing, usually it is best to wait for some clarity and price to show us what it wants to do. For the bulls to get a higher probability to move towards the upside to the highs over here, preferably we are looking for some bullish CVD divergences locally as price then moves towards the upside on, let's say, a 3-minute time frame. Because of the size of the divergences, there is a chance that if price takes the low or the high, the move can be quite volatile, so make sure you trade safe. If we then finally look at the probabilities of the different scenarios, then currently on the daily time frame, the probabilities are higher for the bullish scenario compared to the bearish scenario. Same is true for the 4-hour time frame, and on the 1-hour time frame I wrote neutral here, but with a little bit of an explanation. From an Elliott wave perspective, the first move down from the recent high that we made does not count nicely as an impulsive structure in either an impulse diagonal or a double 1-2. We also touched an 886 at the high. Now generally, because of the structure down, the probabilities would be a bit higher to take the highs. However, we got really big CVD divergences going on, both for the bulls as well as the bears. If I want to increase the probabilities for the bulls in the very local range, then preferably I would like to see some lower time frame bullish CVD divergences as well, let's say on a 3-minute time frame. If price, however, retraces to the downside and we can count a corrective structure, then we're going to be looking for continuation to the upside and an impulse to the upside in a 1, 2, 3, 4, 5 as shown. If, however, the move towards the downside becomes impulsive, we're going to be looking for the lows, and the probabilities will change over here. If price takes the high at 71.8k, the probabilities increase for the bullish scenarios. If price moves down and hits 69.6k, then the probabilities will slightly increase for the bears, as the 69.6k level is the invalidation for wave 4. If price takes 67.2k, then the probabilities will increase for the bears. Be careful with the CVD, as mentioned, big divergences both sides, so please trade safe. I hope that this video was helpful or valuable to you. Please check out the brand new complete Elliott Wave Guide playlist I've made that shows you all you need to know about Elliott Waves. Thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.